When you buy a box of Corn Flakes, you expect to see Corn Flakes in your cereal bowl, not granola or Raisin Bran with a few Corn Flakes mixed in. Consumers rightly expect products to be correctly labelled. But the contents of actively managed mutual funds often vary, sometimes significantly, from their labels or stated benchmarks. This phenomenon is known as style drift. For example, you may have intentionally invested in a growth fund, but unbeknown to you, your active manager has invested 30% of the fund's assets in cash and bonds. Or you may buy a bond fund only to discover, perhaps after a fall in the stock market, that the manager had moved 30% of the assets into equities. That's a big deal. Shifts like those can change the risk exposure, the expected return, and the time horizon of your investment. The primary objective of active fund managers is to outperform their fund's stated style benchmark. When active managers assume their stated style will underperform their benchmark, they may lean away from or even abandon their stated strategies to chase the returns of other investment styles. The problem is, deciding which style to lean towards is far from straightforward. This chart, the Callan Periodic Table of Investment Returns, shows the annual returns for 8 asset classes for each calendar year from 2004 through 2023, with the best performers at the top and the worst at the bottom. The asset classes are colour-coded, and as you can see, high and low returns of key market indexes are completely random, following no discernible pattern. That is what is expected in an efficient market. One of the benefits of index funds is their style purity. For example, if you buy a US small cap index fund, it will contain nothing but US small cap stocks. In short, you know exactly what you're buying with index funds. Style pure investments with the appropriate level of risk and no surprises.